Stamberg. So we have two models here. We have a Pastor Stamberg model. And then of course we have, we have from a French, three-factor model. This is a four-factor model. Four-factor model. So there is a question that you guys were looking for. There is a question that you guys were looking for in the past paper. Were you able to get that question? 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 Yeah, which question is this? Are you able to share it here? November 2020, are you able to share it with us here? Are you able to share with us the question here? Are you able to share with us very fast, November 2020? November 2020. So I'm getting the question very fast because you don't want to share with me. I'm getting it very fast. November 2020. November 2020, CA53. Yes. So part B of November 2020, do we have that question? Are we able to see that question of November 2020? November 2020, question number, November 2020, question number 2, boy. November 2020, question number 2, boy. November 2020, question number 2, boy. Do we have that question? Do we have that question? Do we have that question? Mayoma has sent it, yes. Thank you very much. So the estimated factor sensitivity of Diamond Limited to farmer French factors and the Pastor Stamberg model factors and the risk premiums associated with those factors are given in the table below. So they have given us the table nicely there. This is a good examiner, an examiner who is wishing the students success, an examiner who is wishing students success, an examiner who is not a sadist. They have given us here 4 factors. We have the market factor. So we have the market factor, We have the size factor, and then we have the value factor, and then we have the threshold liquidity factor, right? And then what they have done, they've come here and given us, factor sensitivity. Factor sensitivity, this is the same as your beta. Anytime they talk of factor sensitivity, that is beta. So factor sensitivity, what do we have here for factor sensitivity? We have 1.05. We have minus 0.65. We have minus 0.2. Then we have 0.2, like that. So that is factor sensitivity. So basically they have given us the beta factors, and then we have the risk premium. We have the risk premium, meaning that they have already subtracted for us. So I'm telling you, this is a good examiner who is wishing us what your success. So we have here risk premium. So we have here 5%. We have here 2.5%. We have 4.5%. And then lastly, we have 4.5%. So the treasury bills rate, the treasury bills rate is 5%. The treasury bills rate is 5%. So when you hear them using these words here, treasury bills rate, what comes to your mind? What do you know about treasury bills? What do you know about treasury bills? What do you know about treasury bills? Yes, they are what here? Risk-free. Thank you very much. They are risk-free. So in short, the risk-free is supposed to be equal to what here? 5%. 5%. Thank you very much. You guys are great. So then they want us to do the first thing there. The first thing that they want us to give them, is the farmer French. They want us to give them the required rate of return using the farmer French model. So we have here farmer French, returns of a security. So the most important thing for you to know, ladies and gentlemen, is that farmer French is an extension of arbitrage. It's an extension of arbitrage. And this farmer French, ladies and gentlemen, normally uses the market factor, the size factor, and the value factor. And that is why up there when we started, I told you straight away that farmer French is a 3-factor model. It's a 3-factor model. So we have the first factor is market factor, we have the size, and then we have the value factor. It doesn't make use of a liquidity factor. So in short, ladies and gentlemen, my farmer French returns will be equal to risk-free plus we have the premium into premium of the market, factor times beta 1 plus. So simply follow this. Plus, we have premium of size, or the size premium. Okay, this is the best thing. The size premium times beta 2 plus size premium times beta 2 plus the value premium times beta 3. Remember, this is a 3-factor model. It's a 3-factor model, and the 3 factors are listed here. We have the market size and value. The market size and value. So do we have all these things? We come and plug them in here. Are you able to see the risk-free rate of return? The risk-free rate of return, you guys gave me 5. Remember, in portfolio analysis, we always prefer leaving out what here? Leaving out the percentages. So 5. Are you able to see in this case here the premium, the market premium? Yes. Market factor premium is here, 5. So this market, basically I'm taking this time Evo. So nitakuja hapa niseme plus 5 times 1.05 plus the size premium, size factor premium. It is 2.5 times minus 0.65 plus, there are only 3 factors. The third factor here is 4.5. 4.5 times its premium, which is minus 0.2, like that. So it's called farmer French. The name in this case here may appear to be very big, but really there's nothing there. Nothing. So is there somebody who can give me the value? Anybody who can give me the value here? The farmer French returns. According to Madam Ellen tells me that the farmer French returns are supposed to be 10.975, like that. Can somebody else in this case here second Madam Ellen? Is there anybody who is able to get this figure of farmer French? Imelda has refused. Imelda and so many other students have really refused. Ellen, your figure. Ellen, look at this. Please use your body mass very well. First of all, do the multiplications. And then later on, you'll come and add 5 to your multiplications that have been added. It's body mass. So very many students are able to get 7.725. 7.725. 7.725. Thank you very much. So, ladies and gentlemen, I would want to know whether up to where we are we together? Could you kindly put up a thumbs up if you're together? Kindly put up a thumbs up like that if you're together. If you're not together, please ask a question. Please ask a question. Please ask a question. Thumbs up. Eli, thumbs up. Cyrus, thumbs up. Right. Eli has raised his hand. Please, Eli, because I can't unmute you, is it possible you just ask a question there? Kindly ask a question there. Kindly ask a question there. Kindly ask a question there. Thank you very much. Thank you very much. So from there, now we go to this great pastor. You know, some pastors out there, most of us out there, we are not really able to think beyond the church. But nowadays, there are serious pastors, by the way. You get a PhD holder pastor who is doing quite a lot of research. Jenny, so are we not using the treasury bills rate? Can somebody help me answer Jenny? Can somebody help me answer Jenny, my great dancer? Why are we not using the treasury bills rate? Treasury bills rate is the same as what here? Risk-free rate of return. We used it. 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 The same case, if you go to a question where they're talking over government bonds, anything to do with government is normally risk-free. Thank you very much. I get it. Thank you very much. Jenny now has it. Now, from ladies and gentlemen, we go to pastors Stamberg, returns of a security. So one thing you're supposed to know, ladies and gentlemen, is that Stamberg is a 4-factor model. It is a 4-factor model, which has the first 3 factors, but now includes liquidity. So this one here includes liquidity, includes liquidity. So remember, we have to begin with our normal. So we'll have here risk-free plus we have straight away the market premium times beta 1 plus we have the size premium times beta 2. We have number 3, the value premium. But because this, ladies and gentlemen, is a pastor, a good pastor cannot operate without liquidity. A good pastor must have, you must always emphasize on liquidity. People must give. Tell them to give throughout. People must give. Tell them to give throughout. Tell them that even the first fruits belong to the church. They belong to the church. Somebody put mshahara kwanza yote, and you'll never go wrong like that. You'll never go wrong like that. So then could you kindly come and really do the proper substitutions, and then you give us an answer? Normally what I'll do if I'm the one, because now here this is Stamberg's model, Pastor Stamberg's model, I know I'll multiply all this and I even write the answer down. Look at what I'll do. I'll come and multiply this and this, I write an answer here. This and this, I write. This and this, I write. This and this, I write. And then I'll come and get the total down here. Yes, my own. This is a 4-factor model. It's a 4-factor model. This is a 4-factor model. From a French is the one that is what here? 3. Great. Thank you very much. 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 I think I'll lose you. If I go this approach, I'll lose you. I would rather just write something very big. Let me not be lazy. So risk-free, you guys gave me a figure of 5 plus market premium. This is the market premium. It's 5. 5 times 1.05. So this times this. Plus the size premium is 2.5 times minus 0.65 plus we have 4.5 plus 4.5 times minus 0.2 plus, we come and take the next one, 4.5 times 0.2. Actually, for us who did the ACCA, the multiple choice questions, if I'm the one who was asked this question in an ACCA setup, having gotten in this case here the farmer French, what I would have done was to take the farmer French value and then you say plus, then you go to the multiple choice. But for us, I don't think we have got an option. I think writing it this way. So Gilbert gives me a figure of 8.625, like that. 8.625, like that. So is that correct? Ah, thank you very much. So if somebody asks you to differentiate between farmer French and the Pastor Stamberg's models, what is the clear-cut difference between the two models? Pastors, number of factors, thank you very much. Pastors basically is a 4-factor model. And then we have in this case here, farmer French is 3-factor model. And then you don't forget the fact that Pastor Stamberg's model makes use of all the factors of farmer French, plus liquidity, 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 plus liquidity. So anytime they talk of farmer French, ladies and gentlemen, anytime they talk of farmer French, always think about somebody in this case here who is as big as I am. No, hii ukubwa pia iko na soko yake. Kama kuna mahali mimi naenda, natolewa kofia na naambiwa namna gani mzee keti chini. So I know in this case here, big size will have in this case here a higher value in the market. Size, higher value in the market. If you see, for example, how they test this question in ACCA, these guys will give you so many factors, like 10 of them. Not as straight as this one. Give you like 10 factors, and then they'll ask you to get the farmer French required returns. That is how you should be able to remember that Aura is big in size. Its value must be high. And it always have what here? A market. How many factors? And then when it comes to pastors, now on top of that, you know that pastors, and indeed that is what even the Bible tells them to do, they have to look for liquidity. They must look for what here? Liquidity. Yes, they must look for liquidity. So are we together up to there? Are we together up to there? Are we together up to there? And of course, if your body is tiny, please don't look at me badly. No, 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 no. That's a joke. That's a joke. Great. So somebody repeat the differences. I would want you guys to help me do that. I would want to see somebody giving me the difference. You can even write for them the models. You know, when they tell you to differentiate, even at times you can write down the formula. You say this is from a French formula. This is Pastor Stamberg's formula. And then now from the formulas, we'll be able to say, as you can see, Pastor Stamberg has got what here? Liquidity factor. Liquidity factor, liquidity factor, liquidity factor. Great. Great. Thank you very much. Thank you very much. Imelda, remember, it's not Sternberg. It's supposed to be Stamberg. Stamberg. Thank you. So I hope you guys have been able to see the differences as they have been listed very well with my students there. Now, from ladies and gentlemen, I took you to something very important, how I wish Kasneb was to give me a chance of testing you on these optimal weights. Is there somebody? Thank you very much. Is there somebody who is able to remember the optimal weights, especially WA formula? Of course, I'm not able to see what you guys are doing at home, but could you kindly just be very honest, at least for once? Don't look at your notes at all. Try writing down the formula. Try writing down the formula without looking at your notes at all. Even if you don't get it right, so what? So long as you've decided to trouble your memory a little bit. I taught you yesterday this, weight of A. I taught you this yesterday, weight of A. And please, today, I'll not allow anybody to sleep. Yesterday, you told me that you slept. Today, I'll not allow anybody to sleep. So when you feel like sleeping, tell me to dance for you a little bit. A little bit. I'll be able to sing even for you those good old songs. Aha, I can see Penina. Great, 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 great. So if Penina, you are very honest. So Jerry is asking a very important question. If you're given like 6 factors, I told you like in ACC, I've seen ACC questions where they give you like 10 factors. And from a French, you only pick how many factors? 3. And you know them. And the order doesn't matter. You can start with market size value or value size market. Like that. Thank you very much for asking that question. So we have Nana. Nana tells us it's variance of A. No, Nana umetupa mbao. Hawezi ukaanza na ni ukweli. Ni ukweli. Nimeona vile wamefanya hawa, wamenipatia WB. Yani nimeona vile wamefanya. Otherwise wakisema WA lazima uanze na variance of boy. Zinaenda zikichange. Lazima uanze na variance of boy minus covariance between AB. All over, we have the variance of A plus the variance of boy minus, because there are 2 of them, we'll come and say minus twice covariance AB. Minus twice covariance AB. Thank you. Now, what will happen, ladies and gentlemen, is this. You'll go to an exam. You'll be able to get A, which is 2, 3, 2, 3, 4. Okay. And then we'll be able to get B, which is 6, 4, 5, like that. These are basically what here, returns of A in form of percentages, returns of B in form of percentages, like that. Right? And then now they'll come and ask you required, they'll ask you in the portfolio, what percentage should A take? What will be the weight of A? What will be the weight of A? Remember, please, when they talk of weight of A, always start with the variance of B. If you confuse it, you get it wrong. There is that interchange. Whenever they talk of weight of A, we start with variance of boy. We start with variance of boy. So now here we have a question of 10 marks. They have given us the actual returns of A. They have given us the actual returns of boy, and then they want us to give them the weight of A. They want us to give them the weight of A. They want us to give them the weight of A. Leo kuna wageni wengi sana hapa wametutembelea leo, wengi zaidi. Ni bahati mbaya leo tumekuwa na ile maximum ya 100. Returns of A percentages, like 2%, 3%, 4%. So the percentage is up there, and then returns of B in form of percentages. So kuna wageni wengi leo wametutembelea sana hapa, and I'm so sure our wageni wengi after niliwapatia advice nikawaambia don't go to physical classes, hawakunisikia wakaenda physical classes. You can see how these online students are able to answer great things here. Online students, they catch up these things very fast. no wastage of time. Of course, today I wasted a little bit of time simply because of what I was trying to do to accommodate more students. Mayom is asking for probability. Just like Ellen, who is also asking for probability, it is not always that we must be given probabilities. No, no. I've seen it in these past papers of ours, situations where they don't give us probabilities. So when they don't give us probabilities, what are we supposed to do? Kill ourselves? Nothing like that. We shall just go procedurally. When they don't give us probabilities, if it is the mean, we shall get the normal mean. Right? Right? So in this case here, if it is expected return of A, I'll just get the normal X bar. X bar. Ryan, we are doing this question. We are doing this question, right? We just get the mean. Take the total divided by, take the total divided by the mean. Take the total divided by. So in this case here, expected return of A, which is the average, I'll come and talk of summation of returns of A, and then we divide it by N. And then says 3. You take the summation, this is not E, this is the summation of returns of A. So you add the 3. So we have here 2 plus 3 plus 4 divided by number of parameters. There are 3. Could you kindly give me the answer? Could you kindly give me the answer? 3. Thank you very much. How about expected returns of boy? So expected returns of boy, what do we have? We have 6 plus 4 plus 5. We divide this again by how many numbers? 3 numbers. Divide this by 3 numbers. Thank you very much. The limit is 5. So if I'm the one doing this, given the exposure that I've given you guys, you will come and create, I'll come and create the deviations column. So I'll get the deviation over A from the expected return of A, right? And then I'll come and do again the deviation of B, which is RB minus ERB, like that. Those deviations are very important for me. They're very important for my calculations. Because when you talk of covariance, standard deviations, all of them are measures of the spread. Measures of the spread. So like now here, we can see the actual returns of A. We have 2, 3, 4, and then I'll come and say minus, minus. Minus expected returns of A. Expected returns of A, you guys gave me a figure of 3. So this doesn't keep on bouncing. This will remain the same. This will remain the same. Yeah. Don't square fast. Don't square fast. Never square fast. Don't square fast. Just give me the simple deviations. Give me the simple deviations. So Fatma gives me minus 1, 0, and then we have 1 there. Minus 1, 0, and 1 for A. For boy, we already have the actual returns. So we have 6, 4, 5, minus, minus, minus. Are you able to see the expected return of boy? Yes, it is here. It is 5. It is 5 throughout. So could you kindly give me this simple? So we have here 1 minus 1 and 0. 1 minus 1 and then 0 there. Now, once I have these simple deviations, I'll tell you the metric that is quite easy for us to do what here. I'll tell you the metric that is quite easy for us to come and calculate. It is covariance. It is covariation. So the covariance is quite important. So I would want to see whether there is a single student here who will be able to give me the covariance formula between A and B. Would you kindly try doing that? The covariance formula between A and B. Is there anybody who can do that? The covariance between A and B. Is there anybody who can do that? The covariance between A and B. Is there anybody who can do this? Covariance between A and B. How I love covariance. Covariance is a simple thing. It is the only thing that allows you as a man, gives you permission, rights as a man to be polygamous in nature. It's a bad thing. You can't afford. The economy is not very good. You cannot sustain that. And also now people are quite different nowadays. You'll have trouble, a lot of trouble in your family if you marry too. Nevertheless, whenever they talk of core, you know, core means what? Shared, common variance, the shared variance. Ukipita mahali usikie mtu amesema core wife, there is somebody who is being shared. So in this case, if it's covariance AB, wamama ni wangapi? Wamama ni wawili. Utakuja useme deviation, ama variation of A multiplied by deviation or variation of B times probabilities are not given. Probabilities are not given. Probabilities here are not given. Probabilities are not given. So whenever probabilities are not given, what should we do to average? Come and sum, and then we divide this by n minus 1. For the covariance and variances, we always divide by what here? N minus 1. We only divide by n alone when we are getting expected return. When you're getting expected return, you divide by n. But any other subsequent formula to average, we divide by n minus 1. Reason being, when we got the expected return up there, we lost a degree of freedom. That is not the mathematics that I would want you guys to be doing, to be thinking about. For you, know that dividing by n is only in computations of what your expected returns. Otherwise, in all the other formulas, you divide by what here? N minus 1. N minus 1. Great. So what then this would mean is this. What this would mean is this. Do we have the deviation of A? It is here. It is RA minus ERA minus. And then do we have the deviation of B? Deviation of B, we already have it. It is RB minus ERB, right? So first of all, I would want us to take care of this formula. So fortunately, we have these numbers. So like now here, it will be minus 1 times 1, which gives me minus 1. Next, we have 0 times minus 1. So 0 times minus 1, this and this, which gives me 0. Next, we have 1 times 0, which gives me 0. So when you add the 3, what are we able to get? What are we able to get when we add the 3? Because they want us to sum this multiplied. They want us to sum this multiplied. I'll be able to repeat that Merinjao in a moment. So they're telling me that Mwalimu, this is supposed to be minus 1 all over n minus 1. Remember, n was how many numbers? 3 numbers. So then this will be n is 3 minus 1. So this will be the same as minus 1 over 2, which is the same as minus 0.5. I know the formula that Mary, you are really used to. But first of all, I would want to know whether I can rub this, the upper part of my board. No, okay. No. Especially how I got this. I was taking these simple divisions, multiplying them. Take the simple divisions, multiplying them. Gilbert says, is it 0.5? 0.5 or negative 0.5? Check again, Gilbert. Check again. Because the thing that I want you to do is to give us these joint deviations, the deviations multiplied. For the covariance up here, I need the joint deviation. For the covariance, I need, the WA. Already I've gotten the answer. For WA. So please remember what I've done here is to come and get the joint deviation for my numerator. Joint means you're multiplying them. This is what I did to get -1. This one here gave me 0. This one here gave me 0. So when I added here, I got -1 like that. So please let me know whether I can rub this. Let me know whether I could rub this very fast. Yes, thank you very much. So please, covariance is not -1. Covariance here is not -1. Trust you me. Covariance is not -1. Covariance is whatever you have gotten there as your joint, which is -1 all over n minus 1. N number of values, number of points here, there are 3 minus 1. So then this will be -1 over 2, which will give me minus point what here? Somebody will give me minus 0.5. So up to here, are we together? Are we together up to there? Are we together up to there? Are we together up to there? Are we together? Thank you very much. Thank you very much. Now, Mary Njao. Angalia hapa. I know the formula that you guys are so much used to. It is this formula that I taught you yesterday, where you take, ladies and gentlemen, the deviation of A, which is RA minus ERA, multiplied by the deviation of B, which is RB minus ERB, and then multiplied by probability, and then we come and do it. We come and sum. But you see, at times you will go to an exam, and then you realize that probability has not been given. So if I go to an exam and realize that probability has not been given, I will not start crying. I'm not a crybaby. I'm not a crybaby. Whenever these probabilities are not given, just come and delete P there. But remember to substitute it with what here? N minus 1. So Mary Njao, is that okay now? Thank you very much. At least Mary amesema hapo sasa mwalimu, na siwe peke yako, wengi wana benefitingi, wengi benefit sana na hiyo ikurudia rudia. Kurudia rudia, ladies and gentlemen, usaidia sana. Kurudia rudia usaidia sana. Sasa tukuje hapa jameni. Usikasahau formula yetu ya WA. WA equals who? WA, I gave you a formula. It is variance of B, AB, rather than B, minus the covariance that you guys have been able to give me, all over the variance of A plus the variance of B minus, now because there are 2 of them, so minus twice the covariance of AB, minus twice the covariance of AB, minus twice the covariance of what here? AB, minus twice the covariance of AB. So I've been able to take care of this second bit here, the covariances. Now I would want us to get the variances. So is there somebody there who is able? To give me the formula for variance of A? How do we get variance of A? So to get variance of A, what I'll do, already I have my simple deviation. My simple deviation here is RA minus ERA, but now remember, because of the variance thing, I must come and square. I must come and multiply here with the probability. I must come and do what here, somebody? I sum like that. But when I look at this thing very well, I realize that probabilities are not given. So when they are not given, what do we do? When they are not given, what you do, you simply come and rub this from there, and then you divide this by what here? N minus 1. Remember, this is variance. If they spoke of only standard deviation, then I would have done away with this squared, and of course put what there? Square root. But you see, for the weights, we only need what here? We only need variances. And this is why I love teaching. Look at my book. My book is the best, because now here, the only thing that I need to do is to come and rub this column here, and then I create a new column for this. So we have here RA minus ERA, RA minus ERA squared. Because first of all, I'm getting the numerator alone. So somebody help me square this. So what is minus 1 squared? Remember I told you, you have to put, if it's a negative, you must put it in brackets. So minus 1 squared will give me 1. Jesse, I can see your question. I'll be able to answer it in a minute. So 0 squared will be 0. Then we have 1 squared. 1 squared will be 1. So then this will give me what figure at the end of the day? 2. Ah, 2. Kwa hivyo sasa unakuja straight away, unaweka hapa namna gani? 2 all over. Are you able to remember the value of n? Are you able to remember the value of n? Are you able to remember the value of n? N is 3, yes. So it will be 3 minus 1. So it will be 2 over 2, which gives me 1. Ah, great. I don't even need its standard deviation, because now here we are getting optimal weights. Optimal weights are what here? The very best investment proportions. So now the variance of A is very nicely pinned at home. Very nicely pinned at home. So it means, ladies and gentlemen, that I can come here if you give me the permission here, if you allow me, if you permit me, I should be able to rub this variance of A. Variance of A, can I pull it off? You simply say Y for yes. Thank you very much. Thank you very much. Thank you very much. Wanafunzi wageni, is there a student who is seeing this mwalimu for the very first time? You have never seen this mwalimu any other day teaching, but today is the first day you are seeing this mwalimu teaching. Is there any student like that? So variance of B, as I wait for the responses, variance of B. Variance of B. So it has to be deviation of B squared. Deviation of B, this one. So it will be RB minus ERB squared times probability sum. But this is a question where the examiner has denied you probabilities. So then you need to come and really remove this. You say divide by what here? Somebody n minus 1. Like that. And as I told you, I love teaching simply because there are things which make me very happy. But I'm able to do this that students are not able to do. Yeah, I'm able to play around with my board the way I wish to do with it. So I'll come and create a column here, RB minus ERB squared. Right? So we have here 1 squared is 1, minus 1 squared is 1. Then we have 0 squared is 0, like that, which will end up giving me what summation there? 2. So then we have here 2 divided by 3 minus 1, which will end up giving me what figure somewhere there? Which will end up giving me 1. Which will end up giving me 1. So then, ladies and gentlemen, if that is the case, then I'll be able to come and do the proper plug-ins for getting the optimal weight of A. For getting the optimal weight of A. Now I need to come and do the proper plug-in. Remember, even myself at this particular age, even having taught the paper here for so many years, I always keep on using repetition as a very good tool of learning. I always keep on repeating. So if I were you, at this juncture, I'll put my formula aside. I'll put my book away and try writing this formula down. So we have here WA being equal to variance B minus covariance AB, all over variance A plus variance boy minus twice, because there are 2 of them, covariance AB, like that. So then could you kindly help mwalimu here? Kindly help mwalimu here. Are you able to remember these variances? So variance B ilikuwa ngapi? Somebody told me it was 1. Variance of B, sini 1. Wameanza kulala. So variance of B ni 1. So please don't square. Minus covariance of AB. Are you able to remember this covariance of AB? Already we had gotten it somewhere. Covariance of AB ilikuwa inakuja ngapi covariance? Minus 0.5, I'm being told, like that. All over variance of A is 1, plus variance of boy, which is 1, minus twice, minus 0.5. So hapa lazima ucheze kama wewe. Hapa lazima ucheze kama wewe. So kwa hivyo itakuwa 1.5, right? All over, this is 2, right? minus 2 times, okay, so tutasema minus into bracket, what do we have here? This gives me minus 1. So the two minuses, I'm so sure they'll be plus. So then this will be the same as saying 1.5/3, which will end up giving me what figure? You saw so many students saying that the answer, mwalimu, is 0.5. It can't be 0.75, Abdallah, it can't be 0.75. 1.5/3 will be what here? Somebody will be 0.5. Now let me ask you a simple question. Having gotten WA, what do you think shall I do to be able to get WB? Having gotten WA, what do you think shall I do to be able to get WB? Thank you very much, Silas. It is 1 minus WA. Silas, how I wish this was a good date. You know, when we talk of 26th day of a month, that's a dangerous date. If it was a good day, like second, third there, Silas, I would have straight away given you like 2,000. So blame there. November 2016, question number 2. 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 Part A, we handled it with you yesterday here live. Have we gotten that question? 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 No. Please, somebody get it and try to send it in the group. Get it and try to send it to the group. It's called Explain 3 challenges likely to be encountered . So have you been able to get that question? Yeah, have you been able to get that question? Is there somebody who has been able to send it? Yes. So now I want to do part B. The question of Moses Mapesa. Some of the names should be calling our kids. Wizita mtoto Mapesa na akose pesa. Moses Mapesa. Is in the process of evaluating investments in 2 companies whose percentage returns in the last 10 years are shown below. So we have the companies and the percentage return. I can see company F. I can see company S. So they want me to give them the correlation coefficient of the company's returns. This is quite easy because I did this in CPA section 4. Correlation coefficient will not be able to scare me away. So how do we get correlation coefficient? How do we get correlation? How do we get correlation coefficient R between the two companies, FS? So to get R between FS, what we shall do is to take the covariance between FS divided by their respective standard deviations. Please try to write your R in the proper form. Should be the normal R. Should be the normal R. Only my handwriting is very bad, so I'm writing it this way. Okay. So then if I'm the one doing this question in an exam, what I'll do, first of all, I'll come and write it in columnar form. So I have here returns of F in percentage. So I have 37, I have 24, I have -7, I have 6, I have 18, I have 32, I have -5, I have 21, I have 18, I have 6. And then I'll come and copy the other one. So we have returns of S in percentages. So returns of S in percentages, what do we have? 32. 32. We have 29. 29. We have -32. Actually, -12. -12. We have 1. I'm changing my battery. Okay. Okay, so where are we? So we have -12, 1, 15, 30, 0, 18, 27, and then 10. So once you give me this kind of a question, the very first thing that I will always think about is that I'm seeing that my returns here are fluctuating. The returns are different every time. So what I need to do first of all is to come and ascertain the totals. Is there somebody who can give us the totals here? Very first total of returns of F. Corky tells me it's 115. How about returns of the second security? If I don't love F and S, I can even decide an exam to use this as A, returns of A, returns of Y. So Elizabeth tells me that even the second one should give me 150. Great. So then if that is the case, would you kindly tell me, what do you think would be the next thing to be done? Having gotten the totals like that, what do you think would be the next thing to be done? What do you think would be the next thing we shall do? So come and give us expected returns of F and expected returns of S. So expected return of F, I'll take 150 divided by N. So in this particular question, what is our N? Remember, when you're getting expected returns, we don't divide by N minus 1. Expected returns we always divide by N, which I'm being told is 10. In the same case, would be 150 over 10, which will give us 15. Thank you. Thank you very much. So, then, gentlemen, having gotten in this case here the 2, what do you think will be the next thing to be done? What do you think will be the next thing to be done? The deviations, isn't it? We ascertain the deviations, yes. We ascertain the deviations, yes. The deviations, yes. Thank you very much. We come here and ascertain the deviation. We'll come here and ascertain the deviation. So what do we have here, somebody? We have the deviation of F. The deviation of F. So please come and give me the deviation of F. So deviation of F, what do we have here? We have RF minus ERF. And then we have, ladies and gentlemen, the second deviation will be RS minus ERS. So are you able to give me these numbers very fast because of time? Are you able to give me these numbers very fast because of time? Like a deviation of F will be 37 now minus 15. You keep on taking away 15 from each one of them. You keep on taking away 15 from each one of these. So Merab tells me that the first one is 22. The second one is 9. Please ensure that you finish this thing with high energy. If you want to survive, ensure that you are finishing this thing with high energy, Fatima tells me that the third one is supposed to be minus 22. Minus 22. Abdallah has confirmed the same. How about the fourth one now? The fourth one. The fourth one, somebody telling me is supposed to be minus 9. How about the fifth one? The fifth one is 3. The sixth one, you are taking 32 minus 15, 17. How about the sixth one? Is it minus 20? Minus 20. Please go to the next one. Go to the next one. Give me numbers are right. Merab is quite first, 6. Thank you very much. Second last, 3. And then the very last one. Minus 9. Thank you very much. So on the same breath, come and give me the deviations for S. Remember also expected return of S, we got this as 15. Expected return, we also got it as what here? S15, if you recall. So the first one I'm being told is 6. Nope. The first one, let's start again. 17, 6, I doubt. Oh, it's 32, sorry, how comes? It is 17, 6, yes. Thank you very much. Next one I'm being told is 14, I doubt. Minus 27, 14. Thank you very much. Oh, it's supposed to be minus 14. Is it? Supposed to be minus 14. And then now we have minus 15, giving us, nope, can't be 0. Oh, this is 15, positive. So if it's 15 positive minus 15, that gives me 0. Thank you very much. And then 30 minus 15, that gives me 15. Then we have minus 15. Then we have 3. Then we have 12. And then lastly, if that is 10, this should give us minus 5. That should give us minus 5. Now from there, I know what should follow. If this is my deviation of F, and this is my deviation over S, what I need to do is to come and create a column here for deviation F times deviation S. Please create a column for the two. Deviation F times deviation S. Give me answers again very fast. Time is not on our side. 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 So deviation F times deviation 374, 126. So 374, 126. Thank you very much. Is it 3 or 894? Somebody else is giving me 594. Who is telling me the truth? 126 is okay. How about the first one? The first one, I just want to be very sure. The first one, I want to be very sure the first one. Oh, okay. So the third one, now we are together now. How about the third one? The third one, is the third one the one that is supposed to be 594? The third one. Thank you very much. The fourth one is positive. The fourth one is positive. 126. The fourth one I'm being told is 126. The fifth one, I'm quite cognizant of that, is 0. The sixth one, 225, 255, 255. The next one after 255, 300. 300 positive, 300 positive. Thank you very much. 300 positive. 18. Thank you very much. 18. Thank you very much. From there, we have the next one. Now 36. Thank you very much. 36. Thank you very much. And then the last one gives us what here? 45. So this is a column of covariance. Could you kindly come and add up everything? Give me the total there. Please add up everything and give me the total. The second one is 54. Which second one? Nine times 6. Oh, there is a 9 times 6 somewhere here. So I'm being told there is a 54. I don't know. You guys are, of course, better. So please use your own correct metrics and give me the total. I'm so sure your metrics are okay, your values are okay. And that is why you guys are able to get this 1870 what here? 1874, please. And ensure that you're using your numbers. The numbers are the ones which are correct. So that at the end of the day, tell me whether you're able to get that 1874. Thank you very much. Ladies and gentlemen, having done that, what I'll do, I'll come here first of all and give you the covariance very easily. You know, we have the individual variance, and then common variance. We're applying the two. Great. So we have here covariance between Fs. I'll take the variation of F, deviation of F, multiplied by deviation of S, multiplied by probability sum, but now probabilities are not given. I'll divide this by n-1. So in short, I'll come and take 1874. I divide by 9. Hata ujiona nimetoa 9 wapi? Ujiona nimetoa 9 wapi? Ujiona nimetoa 9 wapi? Ujiona nimetoa 9 wapi? I won't rub off. Yeah, it is 10 minus 1. It is n-1. Thank you very much. It is n-1. So 1874 divided by 9 gives me 208.22. Gives me 208.22. Ah, great. For purposes of getting correlation, I need the individual standard deviation. I need the standard deviation of F. Is there somebody who can write this standard deviation of F formula? Standard deviation of F formula. Standard deviation of F. I know this is a root mean square. Root mean square. So first of all, I have to start with the normal deviation, normal, which is RF minus ARF. And then I'll come and square this, right? Times probability, as usual, right? And then I'll come and add there, right? But I'll remember very fast that this time around, there is no probability. So whenever there is no probability, I'll come and divide this by n-1. And because this time around, they don't want this thing ikiwa squared, ikiwa sigma square, they want just the standard deviation. Kwa hivyo inamaanisha lazima nikuje nibadilishe hiki kitu kofia. Yani uchukue the deviations in ERF, sorry, in ERF. Uchukue the deviations that you have here, and then you do what here, you square them, and then you add them. Yani ukuje uoye, kama ni wewe, mimi nasema 22, sorry. 22 squared plus 9 squared plus minus 22 squared plus etc. Whatever I will get, I'll come and divide by 10 minus 1. So etc sasa umeshaandiki zote hizi. Ukitaka unaweza create hata column yake ya kusquare, ukitaka unaweza create column yake ya kusquare, but the very best is for you to get a calculator. The square, whenever you see a negative, you must always put the negative in brackets. So we want to see whether there is a single student who will be able to give us the standard deviation of F. After you square like that, you have added everything. Don't forget at the end of it all, you have to give us a square root because you want standard deviation. So you must give us a square root. 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 So I'm waiting to hear what my students are able to get as the standard deviation of F. Elizabeth anasema 14.73. Is there anybody else who is able to get that 14.73? I can see Roba. I can see Fatima 14.7. I can see Penina 14.73. Lakini wengi hawajapata hiyo answer bado. Wale washapata, please enda kwa deviation ya S. Niambie deviation ya S ni ngapi? Oscar amesema S ni 15.048 and that is pretty correct. That is pretty correct. Na ngoja kila mwanafunzi anipatie answer before we call it a day. So Fatma anasema 15.05. I'm so sure kuna wanafunzi ambao hawajapata, lakini tafadhali hapana kufa moyo. No, we haven't finished. Remember, the moment you get the core variance and the standard deviations, it should not get lost on us. What this examiner wanted you to do was to get to what we call the correlation, what here? Coefficient. Is to get what we call the correlation coefficient. And to get this correlation coefficient between the two securities, take the core variance between the two, and then you divide by the respective what here? Standard deviations. So the core variance, you guys gave me a figure of 208 point something. The standard deviations here, you gave me what figure? I know the second one is 15.0 something. 5. How about the first one? The first one was 14 point something. .73. So if you are so keen, then we'll end up getting a correlation of 0.94. 0.94. If you're so keen, you'll end up getting a 0.94 as your correlation coefficient. Now, so we've come to the end of this particular class. My next session, of course, I'm going to wind up on a few things of this area, but there are key things I would expect you guys to be reading, like the concept of APM, difference between APM and CPFM, assumptions of CPFM, right? From a French, ingawa from a French, ni kama wanataka kutoa hiyo kitu, sawa ibaki na Pastor Stambach, but there's no harm in understanding the two. And then, of course, this concept of you not being given probabilities is quite a common concept in our past paper. So shall we do that? However, my main topic